What is the difference between accounts receivable factoring and financing? Accounts receivable factoring. Factoring is the outright purchase of outstanding accounts receivable. Factoring is provided to new and growing companies that can't qualify for conventional bank financing. Factoring has no minimum requirements on invoices, value or quantity, so it can be used by small businesses and startups. The business owner can typically choose which invoices to sell to the factor. The factoring transaction has three components. The advance, typically 80% of the face value of the invoice. The reserve, a percentage withheld until the invoice is paid. The discount fee, discount range from 1.5% to 3.5% per 30 days. Your customers are notified that your invoices will be factored and monitored for accuracy. Minimal due diligence includes reviewing clients' financials and performing a collateral search inexpensively within 2 days. It is possible for the invoice to be the only collateral which establishes non-recourse. You sell the invoice, the factor guarantees it, and you receive your working capital. Accounts receivable financing. AR financing is similar to a traditional bank loan. Accounts receivable financing is offered to established companies. AR financing requires a minimum of $700,000 in monthly invoices. All of the accounts receivable are pledged as assets during AR financing. Accounts receivable financing is priced with an annual percentage rate. The APR on accounts receivable financing can range from 7% to 15%. Typically, your customers will not know you are financing your receivables. Collateral checks and audits can cause AR financing due diligence to run in the thousands. The receivable is collateral for the loan, so there is recourse with AR financing. You keep the invoice and account for it as cash and a financing liability. So in a nutshell, here is the difference between AR factoring and financing. Factoring. Outright purchase. Invoices can be selected. Good for small businesses. No minimum invoice rule. Customers are notified. Minimum due diligence. Invoices guaranteed. Collateral, non-recourse. Financing. Loan. All invoices are financed. Good for large businesses. Minimum invoice rule. Customers are not notified. Maximum due diligence required. Invoices not guaranteed. Collateral, recourse. To learn more about the benefits of factoring, take the first step and visit hcmreceivables.smobilemarketing.com.